back into chapter 9, where we're going over variance analysis. So remember, we just finished in the last video talking about, hey, I have my master budget. This is based on my estimated units that I'm going to produce at an estimated price that it's going to take me to produce them, right? Now, my flexible budget, I still keep this estimated price, right? Because I'm still using my standard unit cost, but I'm multiplying it by my actual units. So that allows me to drill down and understand what cost is strictly due to just volume. Okay, so now we're going to start analyzing some other variances. This one is going to be called a spending variance. So spending variance is going to come in between my actual and my flexible budget. So remember, with our flexible budget, we have neutralized it, and we are saying, here's how much I should have spent based on standard cost at my actual level of production. So here, what I'm holding constant is the amount of units that I'm producing. So because I'm holding that constant, any variance is due to the amount spent on the inputs that were used in that product. So from a direct materials perspective, it could come from the price that I paid my vendor or the amount of like the quantity that I had to use. Okay. Again, direct labor, any variance could come from, hey, I wasn't very efficient and it took me longer than it should have. Or, hey, I ended up paying my laborers a different hourly rate than what my standard rate told me that I should have. So I have individual little spending variances for DM, DL, VOH, FOH for my total manufacturing costs down here. So I'm able to say, hey, remember we had 360 over here, and I calculated a volume variance, and that volume variance was 65,000, unfavorable. Now I have a total spending variance that says, hey, I only spent 400 million based on my actual level of output when it should have taken me 425 million. Okay, so now I am in a place where I have a favorable variance of 25 for a total spend variance. So remember, actual results are based on actual input costs. This is actual times actual versus the flexible budget is my actual production volume multiplied by my standard cost over here. So our framework for spending or analyzing spending variances looks a little bit like this. Okay, so spending variances can come from two different pieces. Spending variances can come from my price or my quantity. Again, hey, did I just have to pay a different amount for direct materials than I thought that I did? Or hey, did I use a different amount of direct materials than I thought that I should? Okay, so our goal in doing this is to isolate a single cause for a difference between our actual and our standard amounts while holding everything else constant. So if you think about kind of where we're at, we have our actual, we have our flexible, and we have our master. Between here, we have a volume variance. Between here, we have what kind of a variance? Well, if you come back over here, we see we have spending variances, but that spending variance, let me write that down here, can be broken down into price variance and quantity variance. And then all of these variances netted together are my total budget variances. So a couple of variables to get comfortable with is our AQ is our actual quantity of input. Our AP is the actual price of our input. SQ asterisk is the standard quantity of input allowed for the actual output. We'll talk a little bit more about that. And then SP is our standard price of input. So our price variance over here, if you think about it algebraically, what it's telling me is that my price variance, what is causing the variance here? What is causing this, the whole mathematical equation? It's the fact that I am multiplying the actual quantity by the difference in my price, how much it should have cost me, how much it actually cost me. So I have, with this equation, kind of stripped it down to say, hey, I am just looking at the difference in rate at a constant level of output or at a constant level of my quantity. So again, then I'm just specifying that if my actual costs are less than my standard, my variance is favorable. If my actual costs are greater than my standard cost, the variance is unfavorable. Okay, so again, I'm looking for the two different components of my total spending variance. One is coming from price, one is coming from quantity. Notice how this is different than what we just looked at. Because in my quantity variance, what am I holding constant? My rate or my price. Okay. So because the standard price is the same, I have now been able to narrow down or strip this variance back to just understand the difference in actual quantity multiplied or the difference between my actual quantity and how much quantity I should be using based on my actual rate. Okay, so this right here, we're going to have kind of an intermediate calculation because again, I'm trying to say, here's my standard quantity, which is how much quantity I should use, how much level of input I should use for my actual level of output. So we have to be sure when we're using certain terms here, are we talking about my inputs or am I talking about my outputs? Because my output is when I produce 25,000 units, but my input is when I use 4 pounds of direct materials in order to produce 1 slab of Cliff Bar. So there's kind of a lot of different moving pieces that we have to make sure that we're keeping straight. So just to make sure we understand the relationship between these two, let's go ahead and work through this problem. So here we happen to be doing this for direct labor variances, but the same type of ideology is going to hold true. So here we're given price, quantity, and spend, and we are solving for some sort of a variance here. So in A, I have my price variance, which is $7.50 unfavorable, but I have an efficiency variance or a quantity variance of $1,200 favorable. So I'm being brought down by a price variance, but brought up. So what is my total spend variance going to be? Well, it's going to net out to be favorable, right? Because I have more favorable variances than unfavorable variances. And I know that price variance plus quantity variance equals my spending variance. So again, I don't negate it. I don't assign negatives. All I say is I have $750 unfavorable plus $1,200 favorable is going to give me a net $450 favorable here. Okay. Well, now when you think about solving for a quantity variance, right, I am going to kind of solve this mathematically and say, I know that I have this $350 unfavorable variance that is going to be total, okay? And I'm going to bring this $2,000 favorable variance over, if you think about if it was set up mathematically. And then I'm going to see that I have what? I am being brought so heavily down by my quantity variance. Because remember, I have a total 3,500 unfavorable variance. And that's coming in part from a $2,000 favorable variance. So that tells me that my quantity variance is so unfavorable that it is completely diminishing or getting rid of my price variance that's favorable to pull me all the way down to a $3,500 unfavorable variance. Okay. So again, just think about these different relationships. Think about how this works and what kind of answer you're trying to solve. And then make sure that you can finish the rest of this problem because this is super important to understand how these differences work. So the answers are now on the screen, and we're going to move on and keep talking through different types of variances. So Our direct materials variance, again, what components is my direct materials variance coming from? Well, it's coming from the price that I am paying for my direct materials. And it is coming from how many direct materials I'm using or a quantity, right? So again, it should take me 4 pounds of ingredients, and it should cost me $2 per pound for a standard of $8 per unit that I produce. My actual results, though, tell me that I used 110,000 pounds of ingredients at an actual price of 180. Right off the bat, I identify that I have a price variance, okay? Because it should take me $2, it actually took me $1.80. Okay, it also tells me that I used 110 pounds, so I have an actual level of input here. And it tells me that I have an actual direct labor or direct materials cost of $189,000. So we need to break this into price and spending variances so that I can answer the question, how much of my variance is driven by the amount that we paid for materials and how much is driven by a difference in how much we use our production? So what is the price variance here? Let's start with our price variance. Well, I know if you want to flow through our DM price variance equation, you're more than welcome to. I know that that's my actual quantity multiplied by what? What do I keep constant? My rates, or sorry, oh geez, I kind of messed that up. What do I hold constant is my actual quantity, and then what I'm subtracting here is my price, so it allows me to narrow down on, hey, what is actually driven by price? Well, my actual quantity, right, it tells me is 110 pounds of ingredients. Notice this isn't my level of output. It's the quantity, right, that I use to create my outputs. It's my input. Okay, I'll write that up here. This is my input. And it should cost me $2, but it only cost me $1.80. So if you do the math on it, you're going to get a $22,000 variance. Now you have to answer the question, is it favorable or unfavorable, and why? Well, it should cost me $2 and it only cost me $180. So I have a favorable variance here because my actual cost is less than what it should take me or my standard. Okay. So what could cause a difference here? Well, that's probably going to come from our purchasing manager. Okay. Because they went out and acquired these goods or these direct materials. And we're trying to answer the question of like, hey, why do you only pay $1.80? Well, maybe the purchasing manager is awesome and negotiated a reduced price. Maybe we got a bulk quantity discount, but we didn't factor that into our standard price. Or maybe we purchased really low quality materials and that's going to come back and bite us. So again, try not to assign like, hey, it's automatically a really good thing that I have a favorable variance, because we need to understand the other qualitative factors that are going to allow us to determine that. Okay. So now I have kind of narrowed one piece of my total variance down, which is going to be my price. What variance do I need to look at now? My quantity variance. Okay, so how do I calculate my quantity variance? Well, I'll say my DM quantity is going to equal this funky little guy that we haven't talked about too much, which is my SQ asterisk plus my actual quantity. What do I hold constant? My standard price. So what is this SQ asterisk? We are always going to have an intermediate calculation for this, because this is saying how much should it take me in my inputs to produce the actual level of outputs. Okay, so how many pounds of ingredients should I use? I should use 4 pounds. How many units did I produce? 25,000. So this is my input, and this is my output. So how many pounds of ingredients should I have used to produce 25,000 units or 25,000 bars or slabs? Well, I should have used 100,000. Okay. How much did I actually use? Well, I used 110,000. At what price? $2. So I get a total variance of 20,000. Is it unfavorable or favorable? And again, you just have to ask yourself, like, you have to converse with yourself when you're working through these types of problems, because I'm not able to look at this and just know automatically what type of variance it is. But what I'm going to look at is I'm going to say, okay, it should have only taken me 100,000 pounds, but it actually took me 110,000 pounds. That tells me I wasn't very efficient. I used more quantities, or I used more inputs than I should have based on my standard. So here, right, it is an unfavorable variance. So it's an unfavorable quantity. Sometimes I refer to it as an unfavorable efficiency variance, right? Because I used more than I should have. And then the question becomes, well, why? Like, why did I do that? Okay. Why did I have to use 110,000 pounds when I should have only had to use 100,000 pounds? Well, maybe I had to throw away some ingredients because they didn't meet the company's quality standard, because my purchasing manager bought low quality products at only $1.80. So now, thanks so much, purchasing manager, you kind of screwed me over. Or is it because, hey, there was a faulty oven and some of my products were discarded? Okay, like, I don't know, maybe the oven exploded or something and I lost so much direct materials that it really impacted my variance analysis here. You know, so again, it's going through and saying, how do I balance this quantitative unfavorable variance with understanding the qualitative factors to it as well? So here you can see that we are just putting this all together. So I had an actual level of input of 110,000 pounds of ingredients, and I spent $1.80 per pound. So I will have an actual result, right, of 198,000. We knew that going into it. That's what they told me. Okay. Now what I need to do, though, is compare that to my flexible budget. And how much is my flexible budget? Well, my flexible budget, remember, I've held constant that it's at the same level of output units produced, 25,000. So the only difference here is going to be coming from some sort of price variance and some sort of quantity variance. So my standard or my flexible budget is going to be saying, hey, it should take me 100,000 units or 100,000 pounds of direct materials ingredients at a standard price of $2 per pound. So it should take me $200,000 in direct materials. Okay, so it actually only took me 198. So I get a total spend variance of $2,000 favorable. But what else do I know? Well, I know that that doesn't allow me to understand the difference between my quantity and my spending. Or quantity and my price. So I break that down and I say, well, how much is driven by the price that I paid, the difference in the $2 that it should cost me versus the $1.80 that it actually did cost me, and how much is driven by my quantity efficiency, right? Where I should have only had to use 100,000 pounds, but I actually used 110,000 pounds at a constant rate of $2. So notice when you take your price variance of $22,000 favorable and you add that to your $20,000 unfavorable, you will get the same $2,000 favorable variance that you get right here. Okay. So I would make sure that you could do a question like this, okay, and answer the direct materials cost variance. I'm going to go ahead and keep cruising through so that we can talk about our direct labor variance. Because once you understand one of these variance analysis, it's much easier to go on and understand the differences or the other variance analysis framework. So here in our direct labor variances, we are going to be doing the same thing, right? We are going to have some sort of a price variance and we're going to have some sort of a quantity variance. The only difference is here, we're calling them something different, but I don't want you to get caught up in that. Okay. Again, just think rationally about the things that we're talking about here. Because right now, we're saying that, hey, my price, well, yeah, the price that I pay for direct materials, it's kind of the same idea as the rate that I pay my direct laborers. The quantity, the amount of direct materials that I use, is similar to the labor efficiency, how many hours it takes me to produce a unit. So in this case, we're saying that each unit or slab of Cliff Bar requires 0.2 hours of direct labor. So that is a standard, that's a standard, how much it should cost me. And I have a standard rate of $20 per hour for a standard direct labor cost of $4 per unit. So it should take me $4 in DL for every slab of Cliff Bar that I produce. Now what it's telling me is that I paid $81,000 in actual direct labor wages, and I used 4,500 actual hours here. Okay, so I'm going to do a couple of calculations before we go and start plugging in what we actually know. Are we given our direct labor actual rate? Well, no, we're not. But we're given something that allows us to calculate it. And what we're given that allows us to calculate it is that I paid $81,000 in total direct labor wages, and I'm going to spread that across $4,500 or 4,500 hours. So I'm going to get an actual direct labor rate of $18 per hour, which right off the bat I see is different than my standard that I thought that I should pay of $20 per hour. How many direct labor hours did I use? Well, there's nothing funny to do here. I'm just going to pull this down and say I did use 4,500. Again, I'm just pulling this information down, my standard labor rate. And the reason that I'm doing that is just so that I'm in a good spot to start comparing these things. Now, this one is a little bit funny, and this one is going to be my standard labor hours. Okay, so standard labor hours. What variable is this equivalent to? It's going to be SH asterisk. So how much input should I use to produce my actual level of output? So I have my standard variance or my standard rate. Not rate, sorry. I have my standard input of 0.2 hours. Okay. At my actual level of output. I'll specify output. So to produce my actual level of output, it should take me 5,000 hours. Okay. And right off the bat, I'm going to look at this and say, but it only took me 4,500. So what two variances are we going to come through and calculate? Well, we're going to calculate our rate variance and our efficiency variance. So here we have our rate variance, and our rate variance is going to be what? What are we going to hold constant? We're going to hold constant the actual hours that it took me, and I'm going to multiply that by the difference in my rates. So my standard rate multiplied by my actual rate. So it took me 4,500 actual hours. I should pay $20 an hour, but I only paid $18 an hour. So I have a variance of 9,000. And is it favorable or unfavorable? Well, again, think about what this is telling me. I should be paying $20 an hour. I'm only paying $18 an hour. So I have a favorable variance because my actual cost is less than my standard cost. What might influence the rate variance? Well, that's probably going to be due to my hiring manager or somebody similar. Did I hire really unskilled laborers, right? Like, did I hire people that are maybe straight out of high school that don't really know that much, and I'm able to get by with hiring, or I'm able to get by with paying them less? Because that's fine if that is the case, but then you have to understand that they might mess up a little bit, right? I'm paying them less because they're unskilled. Okay. Maybe the labor market is just demanding this rate, right? Because there's higher unemployment, so people are willing to work for less money. Or, maybe there's turnover rates for direct labor workers within the company. So the biggest thing is, and this is what I keep trying to kind of say, is that a favorable rate variance may not be good, particularly if it's due to a factor that's going to not really help out or improve our total company. Okay. So now we can figure out our direct labor efficiency variance. So our DL efficiency variance. And what do we think that's going to be equal to? What do we want to hold constant here? Well, my standard rate. That's what I'm going to hold constant to be able to strip down and understand the difference in how efficient I was. And how efficient I was is going to be driven by what? How much it should take me to produce my actual level of output, less how long it actually did take me. So if I look at this SH asterisk, we already figured this out, right? But I'm going to go ahead and do it again, right? And I'm going to say how many hours should be used for the number of units that we actually produced. Well, I should use 0.2 hours, and I actually produced 25,000 Cliff Bars. So again, here's my output, and here's my input. Okay, so I'm going to get 5,000 when I multiply 0.2 by 25,000. And then I say, how many hours did I actually use? Well, I actually used 4,500. What's my standard rate? $20 per hour. So I have 20 multiplied by 500 is going to give me $10,000. And is that favorable or unfavorable? Well, again, it should take me 5,000. It only took me 4,500. So I was efficient, right? And I have a favorable variance here. And I have a favorable variance because the standard number of hours that it should have taken me to produce my actual level of output of 2,500 or 25,000 is greater than the number of hours that it actually took. So looking at this framework again, I have my direct labor variances, and I'm saying I'm going from my flexible to my actual. Both my flexible and my actual are based on my actual level of output here. But I know that just bopping between the two and understanding my spending variance doesn't allow me to really drill down and understand how much is driven by my rate difference versus how much is driven by how efficient I am. So I'm going to break that down, and I'm going to say, what's my rate variance? Well, it's my 9,000 favorable that I just calculated. What's my efficiency variance? Well, it's 10,000 favorable that I just calculated, for a total of $19,000 favorable. So I have a total favorable spending variance, which is driven in part by being efficient and driven in part by using cheaper labor. Okay. So now that again has allowed me to understand more information and be able to ask questions to people in the business and understand why these variances are what they are. So let me know if y'all have any questions, but that kind of sums up total variances here. So the same exact idea applies for any sort of variable overhead, where we are going to strip it down and understand how much is due to the rate, right? My predetermined overhead rate versus the actual rate that I use to assign variable overhead, and how efficient I was. We are not going to look at fixed overhead variances in this class. If you do take more advanced managerial accounting classes, that is definitely something that you will look at, but it gets a little bit more complex in the mathematical calculations, so we are going to skip that. But as always, let me know if y'all have any questions. Otherwise, enjoy the rest of your day, and I will see you back here for chapter 10. Bye now.